Welcome back to Fast Money. It's been a hot year for the housing trade, but our next guest says there could be trouble on the home front as we head into 2021. Let's bring in Matthew Poynton, property economist at Capital Economics. Matthew, great to have you with us.
Hi.
We've heard about the flight from cities. Mortgage rates are at record lows or close to record lows. What causes this reversal as you're forecasting?
Yeah, well, there were three main factors driving the housing boom over the past year. One, as you mentioned, was record low mortgage rates. The Fed stepped in, cut rates. They also increased their purchases of MBS. And then you had no real transactions over the spring because of the economic shutdowns. So all that demand was shifted to the second half of the year. And so that's why sales took off. And finally, you got this displacement effect where people had enough of cities. They couldn't stay in cities any longer. So they decided to move to the suburbs or perhaps even further afield. And although those three factors, they're not really going to continue into the next year, we think mortgage rates will stay very low, probably close to record lows. But they're not going to drop any further. We're forecasting 10-year yields to stay around 1% for the next 2 years. Mortgage rates around 3%. But they're not going to drop any further. And that means that the boost to affordability we've already seen, that's going to fall off because house prices are taking off. And that's already cut out the advantage you've got from those lower mortgage rates. At the same time, you haven't got this pent-up demand from the spring. That's going to be exhausted. That's going to fall away. And with vaccines coming through, life is going to start to return to normal. And all these people who left maybe want to go back to cities. We don't think that move away from cities will continue.
So it sounds like it's just sort of a natural mean reversion trade going on within the housing market. I mean, housing prices are going to go higher. That eventually is going to sort of be self-capped because people want to pay those prices and people want to get back to normal. So that boom in the suburbs, that's over.
We think it's, certainly next year sales are going to drop back to a past trend. Also, I forgot to mention the supply side is very important here. There's just not enough homes for sale. The number of existing homes for sale has dropped to record lows every month for the past 6 months. We don't see that improving next year. So if you wanted to buy a house, it's going to be a struggle next year. And people, they're going to probably wait their time to see if anything better comes available.
Thanks for joining us. When you look across segments in housing, whether it be cities versus suburbs, multifamily versus single family, would you mind isolating where you think the most weakness will be?
I think next year it's going to be single family. So this year it was very good for single families. People left the cities. They bought up nice homes in the suburbs. Next year, I think that's going to start to reverse. We saw a lot of people leave cities. Many of them didn't buy a house. They just sort of moved in with their parents. There was a spike in the share of people living with their parents. And as life returns to normal, we think they're going to start to come back to cities. There's also been very aggressive rent cuts in most big cities. And that should encourage a lot of these people back home, out of the suburbs and further afield, back into cities. Where, it's not just, cities aren't just good for jobs, they're there for many other reasons. You can come back for the culture, entertainment. And as that comes back, those people should move back.
In terms of your forecast, Matthew, for where 10-year yields stay and where mortgage rates will remain, or you said around 3% next year, how much of that is predicated on the notion that the Fed will stay with its MBS purchases and keep that steady as opposed to reallocating the MBS purchases to other parts of the Treasury curve?
I think they're committed to buying up $40 billion a month for now. I'm not sure that's going to make a huge difference when they ease off on that purchases. We saw before when they eased back on MBS purchases, there wasn't a big impact on mortgage rates. I think as the economy recovers, banks become more comfortable with lending on housing, then the spreads will stay about where they are as it is. So I'm not sure it's going to have a huge impact if and when they start to pull back from the MBS program.
Matthew, great to speak with you. Thank you. Matthew Poynton of Capital Economics.
Shepard Smith here. Thanks for watching CNBC on YouTube.